At a kitchen table after a night shift, Mara, a hospital technician, opens 2025 tax software beside $15,000 of overtime pay. She expects the new overtime deduction to match that number. Then one calculation turns $15,000 of overtime into a $5,000 deduction. That gap is not a typo, and it is not a payroll mistake. It is the rule behind the no tax on overtime headline today. Her story is a composite, but the filing decision is real for workers sorting through 2025 records during this year's tax season now. The IRS says qualified overtime is generally only pay above a worker's regular rate that federal overtime law requires, not every overtime dollar. For Mara, distinction starts with one familiar shift, 40 regular hours, then extra hours paid at time and a half that week. At a regular rate of $30, one overtime hour pays $45. $30 is ordinary wages, the extra $15 is the premium portion. The FLSA required premium and standard time and a half pay is that extra half. It is 1/3 of the full overtime amount, not all of it. Multiply Mara's $15,000 of total overtime pay by 1/3, and the qualified compensation is $5,000 before income-based limits apply. That exact $15,000 to $5,000 example appears in transition guidance for 2025, designed for taxpayers whose employers did not separately identify qualifying amounts on forms. Before entering any number, consider separating total overtime paid from the legally required premium. Those are related numbers, but they are not interchangeable. The headline feels simple because it uses one word, overtime. The tax rule uses a narrower phrase, qualified overtime compensation under law. That phrase connects the deduction to the Fair Labor Standards Act, the federal wage and hour law that sets baseline overtime rules for covered employees. Most covered, non-exempt employees must receive at least 1.5 times their regular rate after 40 hours in a work week under the FLSA. Coverage and exemption are fact-specific. A hospital job title alone does not settle eligibility, even when a pay stub uses the word overtime. If Mara is hourly and non-exempt, her case may be straightforward. Salaried workers, managers, and specialized schedules may warrant a tax professional review. Extra pay required by a union contract, state law, or employer policy is not automatically qualified if federal law did not require it. Think of the FLSA premium as the mandated cover charge, not the whole dinner bill. The deduction follows the required extra, not generosity. If a contract pays double time, the deduction generally excludes dollars beyond the federal law-required premium. Only that required premium qualifies for this deduction. Special public safety schedules and alternative overtime arrangements can also complicate the math. The relevant question remains what the FLSA required for those hours. Consider avoiding reverse engineering from a large overtime total. Start instead with the regular rate, qualifying hours, and premium applied to a payroll period. Mara assumed her year-end form would answer everything. Instead, her W-2 shows wages and withholding, while the calculation she needs lives elsewhere. For tax year 2025, employers generally were not required to separately report qualified overtime compensation on Forms W-2, 10999 NEC, or 10999 MIC to workers. That transition rule means a blank overtime box does not prove zero eligibility. It means the taxpayer may need to reconstruct qualifying premium. Consider gathering every 2025 pay stub, time card summary, overtime report, and year-end payroll statement before filing. Save digital copies with return work papers securely. One approach, identify overtime hours by pay period. Note regular and overtime rates. Then isolate only the portion above regular pay before calculating. With ordinary time and a half overtime, one approach is dividing total overtime pay by 3. That shortcut mirrors the premium only when rate is standard. The IRS directs workers without a separate employer statement to use the Schedule 1A instructions to calculate qualified overtime compensation for their return. Consider the instruction set because pay systems differ. A shift differential, bonus, or blended rate can make a 1/3 calculation incomplete or inaccurate. Consider asking payroll for an overtime earnings detail and regular rate calculations. Ask for records, not a tax conclusion, because payroll cannot provide one. Mara finds a stack of stubs in a drawer, but her hospital's portal has more detail: hours, codes, differentials, and gross pay history. Her documentation must support the claimed amount if the IRS asks later. The deduction is claimed by the worker even without separate reporting. Consider keeping the calculation with return records, overtime paid, applicable regular rate, qualifying premium, and payroll explanation. Good records reduce filing stress later. The deduction is available whether you take the standard deduction or itemize. It reduces taxable income. It does not erase payroll taxes withheld. That is another kitchen table surprise. A $5,000 deduction is not a $5,000 refund. Its value depends on the taxpayer's overall tax picture. Consider treating the deduction like a coupon against taxable income, not cash from payroll. Its benefit may vary with income, credits, and withholding. For an individual, the annual cap is $12,500. For a joint return, it is $25,000 before phase-outs. Those limits begin phasing out above modified adjusted gross income of $150,000 or $300,000 on joint returns. A married taxpayer generally must file jointly, and the worker needs a valid Social Security number for employment to claim this deduction. Before estimating any benefit, consider checking filing status and modified adjusted gross income. Tax software can help, but unusual facts may justify review. At this point, Mara has two separate questions: what premium qualifies and whether her household income trims the deduction she can actually claim. The deduction does not change the overtime wages reported in income. Workers first include their pay, then claim the separate deduction if eligible. Schedule 1A is the form pathway for this new deduction. Its 2025 instructions explain calculations when employer reporting is unavailable or incomplete. Consider entering the number only after you can show the bridge from overtime hours to premium pay. A worksheet can prevent inflated claim. One approach is to flag period with holiday premiums, bonuses, retroactive adjustments, or changing rates. Those are moments when the shortcut may break. A coworker tells Mara, "Overtime is tax-free now." That sentence sounds comforting, but it blends a deduction with the pay that created it. The IRS calls this a deduction for qualified overtime compensation, not an exclusion of all overtime from wages, withholding, or employment taxes entirely. Language matters at filing time. Consider asking, which required premium qualifies, instead of, how much overtime can I deduct this year under law? Beginning with tax year 2026, separate reporting of qualified overtime compensation is required on updated information returns, reducing this particular transition year detective work. That future reporting should help, but it cannot fill Mara's 2025 gap. Her current return still depends on records she can substantiate today. Consider setting aside an hour before filing. Download records, list overtime periods, calculate premiums, check income limits, then compare with Schedule 1A instructions. If records conflict, consider pausing instead of guessing. A tax preparer or employer payroll contact may help reconcile hours, rates, and premiums. FLESA coverage itself can involve enterprise coverage or individual coverage, which is why employer type and job duties sometimes matter beyond a title. Hospital workers should not assume that their setting alone answers the FLSA question. Consider reviewing classification, duties, and pay method before claiming anything. Mara's regular shifts, night differentials, and weekend coverage make her pay stub busy. The goal is not perfection, it is a supported, rule-based number. An employer may report qualified overtime separately for 2025, but generally was not required to do so during the transition year under guidance. Consider comparing any employer statement with your stubs before filing. If it differs, ask what earnings and premiums it includes for the calculation. Workers can claim the deduction even if they use the standard deduction, so Mara does not need itemized deductions to reach this step. Consider eligibility separately from value. A qualifying premium may exist, yet income limits can reduce the deduction and its eventual tax savings significantly. Her final worksheet does not celebrate $15,000 or more than $5,000. It simply separates wages, qualified premium, and potential deduction clearly. That is the win, a number she can explain. Consider saving the worksheet with her return and revisiting it if questions arise. One approach before filing: check eligibility, premium calculation, income limits, and documentation. Miss one, and the deduction may be misstated later on return. Like this kind of paycheck forensics? Subscribe for practical money questions handled carefully, one real-world decision at a time, without the headline fog. Consider accurate records at filing. Claiming too much can invite corrections, while claiming too little may leave deductions unused for no reason. Remember, Mara's $5,000 is a calculation example, not a promise for every worker. Different rates, exemptions, and income can change the result. The annual caps do not turn total overtime pay into qualified compensation. The premium calculation comes first. Caps, phase-outs may limit deduction afterward. Consider using official instructions as the tiebreaker when payroll language and headlines collide. They address the calculation broad summaries routinely skip entirely today. The IRS says the deduction is tied to qualified overtime received during 2025, placing the focus on compensation and records for that year. The next time a headline says no tax on overtime, hear the missing question underneath: which overtime, calculated how, for which worker exactly? Consider writing that question atop your payroll packet, then answer it with pay stubs, hours, rates, FLSA status, and Schedule 1A instructions carefully. This content is for educational and informational purposes only and does not constitute financial advice. Always consult with a qualified financial advisor before making investment decisions. Mara files with a smaller number than she expected, but a defensible one. In taxes, the cleanest answer is often the calculated answer. $15,000 on the stub, $5,000 in qualified premium. The difference is where filing starts and where costly assumptions stop. Remember, this content is for informational purposes only and is not financial advice.